Namaste, welcome to Arthaniti. Today I want to tell you about this amazing investment strategy called Rupee Cost Averaging. Now, when we invest our money, our aim is to get maximum returns from those investments. After all, we have worked really hard to earn the money. We have saved the money and we have invested the money. So, three-fourths of the part we have done absolutely right. So then what is the harm in expecting good returns from those investments? Nothing wrong in it. But we know for a fact that not all investment options give us good returns. So then which is the avenue that helps us get good returns? Well, we know the answer for that as well. Stock markets, correct? Stock markets are a place which will help us get exponential returns, but they have an inherent risk attached to them. Now, most people are averse to taking those risks and therefore stay away from the stock markets. Few days back, I was reading an article where an infographic was published, and the infographic showed that New Delhi had the highest number of retail investors in the stock market, somewhere around 23%. Now, New Delhi was followed by Maharashtra and Gujarat, and the remaining states lagged behind. So we know for a fact that only few people take the risk and invest their money in the stock markets. Rest are fearful of losing their money. So instead they plan to stay away from it. But then if you want your money to grow at a healthy pace to outperform inflation, you will have to take some amount of risk. Where there is risk, there is reward, correct? So while investing in the stock market, if you want to lower your risk but still get benefits from the stock market, rupee cost averaging should be your investment strategy. That is the answer to your problem of risk. Now, how does rupee cost averaging work? Now, say for example, you want to invest, say, in an Infosys share. Now, Infosys currently is trading somewhere around 1880 odd rupees. You don't know whether this price is a good enough price to buy those shares. In the sense, when you invest in stocks, the experts normally tell us that you should always buy a share when it is undervalued. In the sense, in a bearish market, you should always buy a share so that you buy at a low price. And you should always profit from a share when it is trading at a higher price in a bullish market. But can you predict whether the price at which Infosys share is currently trading is a low price or a high price? Whether it is going to achieve greater heights from where it is trading today, or whether it is going to reduce in its price from where it is trading today? Well, if you are new to stock market, it is impossible for you to predict it. Even players or investors who have been in the stock markets for many years, who study the stocks, cannot for sure predict where the market and a particular share is headed. So it is quite impossible to predict the cycles in the stock market. So how do you enter the stock market then? So I'll give you an example. Say suppose you have 50,000 rupees to invest, and say suppose Infosys share is getting traded for say 100 rupees. Hypothetical example. Now instead of putting in the whole 50,000 rupees at one go for a 100 rupees share, what you do is you divide those 50,000 in equal amounts. Say 5,000 rupees each. So you have 10 different 5,000 rupee amounts which you will invest not in one go but at a specific date every month. So 5,000 rupees, say suppose you invest on the 10th of April. Say for example, the first installment of 5,000 goes into purchasing Infosys share which is trading again, for example, say at 100 rupees. So what is the number of share that you will get? 5,000 for an Infosys which is trading at 100 rupees. What is the number of share that you will get? 50 shares. Next month, say in May 2022, on the 10th of May, you put in the next 5,000 installment and Infosys is trading at say 200 rupees. What is the number of shares that you are going to get? 25. Correct? Come to the third month, say in June 2022, Infosys share has come back down to 100 rupees. Now, when you put in your 5,000 rupees, you will get 50 shares again. So, in the first month, you got 50 shares where Infosys was traded at 100. In the second month, you're going to get how much? Sorry, 25. I lost count. I'm sorry. 25 shares when Infosys was traded at 200. In the third month, again, you're going to get 50 shares when Infosys share price has come back down to 100 rupees. Now, every time the share price reduces, you are going to get higher number of shares, and every time the share price increases, you are going to get lower number of shares. Now, when you keep on doing this for a long period of time, what is going to happen is the unit cost per share that you have paid for purchasing the shares of the company is going to go down, right? So this has to happen not for 2 months, 3 months, but for over a longer duration of time, so that the cost of each individual share will average out. That is what rupee cost averaging helps you to achieve. Now, over a period of time, what normally is seen is the indices are always, even though they go in a cyclical nature, over a period of time, indices always increase. Now, when with this increase, the value of your shareholding is also going to increase, where the cost has been averaged out with the help of rupee cost averaging. The value of your investment will increase with the increase in the indices. Correct? So I hope you have understood what rupee cost averaging is. Now, what are the advantages of rupee cost averaging? As I told you, in our investments, especially in a fluctuating investment option, when we see the share price fluctuating to highs and lows, it is emotionally quite stressful. And if we are not disciplined enough, we will tend to make mistakes by selling the shares when it is in a downward cycle and buying it when it is in a upward cycle. So we'll do exactly opposite of what is normally advised to be done. So to avoid that emotional quotient from our investment, if we decide to put in a fixed sum at a fixed date, that emotional quotient is taken away from our investment. So our investments become more practical. Next thing, if we are risk averse, if we are new to the market and we want to reap benefits out of it, but we do not want to, we want to significantly reduce the risk involved with investing, rupee cost averaging is the strategy that you should be implementing. Well, it does not work all the time. Okay, now if you are sure about a particular investment, if you have studied thoroughly the kind of investment that you want to make, then investing in bulk is going to help you achieve exponential growth. With rupee cost averaging, what happens is, as your costs are averaged, your returns also are averaged out. Understand, you will get returns, but they are averaged out. With bulk investing, provided you have studied well and you are taking an informed decision where you are ready to give the required time for the investments to give you fruitful returns, then bulk investing is the way for you. If you are not new to the stock markets, if you are an experienced investor, then bulk or lump sum investments is the way for you. But if you are new, if you are inexperienced, if you are risk averse, go the rupee cost averaging way. Correct? Now, as I told you about stocks, rupee cost averaging can also be achieved by investing through mutual funds. Now, these schemes of mutual funds normally which invest in stock markets like equity and equity related schemes, if you do a SIP, a systematic investment plan, in that particular mutual fund, it will help you achieve the same benefits as you invest directly in the stocks. So it will help reduce the cost of per unit of a mutual fund that you will purchase. It will imbibe a discipline, a habit of investing, saving money, and it will help you give returns with lowered risk over a longer period of time. Correct? So you can either use this rupee cost averaging strategy while investing directly in stocks, or you can use it by investing through the SIP route, the systematic investment plan route, in a mutual fund which is targeted towards equity and equity related instruments. Correct? If you are new, if you are risk averse, if you want to take advantage of the stock market returns with lowered risk, rupee cost averaging should be your investment strategy. I hope you like my video. Please share, subscribe to my channel, and help me add little value with each of my videos in your investment journey. See you until next time. Bye.